Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. This week, exceptionally, I am not in the country, and one of the conversations I had scheduled to go out in the podcast had unfortunately to be deferred. So instead, I'm only going to record a short edition this week, and I thought it might be a good idea to take a look back at what's been happening this year in the investment trust sector, drawing quite heavily on recent broker research, most notably from Numis Securities, now part of Deutsche Bank, who produced a very useful guide to all the activity that's been going on in corporate terms this year. So it's not all just about performance. As you will know, there's been an extraordinary amount of activity introduced by boards in an attempt to deal with discounts or to deal with the issue of scale or to deal with the issue of higher than tolerable costs across the sector, all of which have contributed to the decline that we've seen in the number of investment trusts over the last 3 years. Now, it's fair to say that actually the performance of investment trusts year to date has been reasonably good. The average investment trust has delivered a return of something around 15% so far this year. A lot of variation around that number, of course, there always is. And that is pretty impressive if you think that inflation's been running at latest figure 3.8%. So that is a double-digit real return on average across the sector. And most of that has come from the performance of the assets that these trusts own, not from discount narrowing. Because overall, discounts have been, I think on average you could say, been trending sideways, but they've been trending sideways at a level that is still wider than we were become accustomed to in the previous decade. So for equity trusts, it's something in between, I think, around 9% on average. And for alternatives, much wider, nearer 25 to 30% on average. Both these cases, of course, we have to allow for the fact that there is survivorship bias in the numbers. The number of investment trusts has been shrinking, as by now everyone will be aware. In fact, I think the numbers, if you take AIC data, there's down by around 20% over the last couple of years as a result of trusts either winding up, being liquidated, merging, or being taken over, all of which can be traced, at least in part, to the discounts widening that we've seen since the end of 2021. So it's been a very tough period for the investment trust sector, but one that also has brought out some of its better qualities, namely the ability to adapt and reform and tolerate the Darwinian process of regeneration. My general theme for the Investment Trusts Handbook, which I'm literally about to send off to the printers, covers all these things I'm going to talk about in much more detail, so please do look out for that. The general theme of the handbook this year has been remaking the case for investment trusts. In other words, for all the drama we've had, the impact of Donald Trump on the markets overall, and the impact of Saba Capital, most notably in terms of corporate activity over here in the investment trust sector. That's been working its way through and responsible for the shrinking of the sector, but also has been highlighting both the need for the trust sector to remarket itself, if you like, to remind investors of the many strengths that the investment trust sector has and what the best quality investment trust can do for you as an investor. So reminding investors of that thing, and also, of course, taking steps to ensure that this recovery that we've seen over the last 12, 24 months for many trusts in terms of performance can be continued, and that the investment trust sector can continue to stay competitive when compared to other alternatives that are out there, particularly passive funds, open-ended tracker funds, and exchange-traded funds, ETFs, that follow a passive investment strategy, and new upcoming competitors in the form of active ETFs, now becoming more popular, and what are called LTAFs, long-term asset funds, a kind of hybrid vehicle that the government has been pushing, and which it thinks might make a suitable home for unlisted assets, private assets essentially, where there's not a liquid market every day. You might think, and I certainly think, that this is not a particularly helpful solution, at least for individual investors, when the investment trust structure provides a perfect vehicle for unlisted assets, for those with the patience to sit them out, as investors in LTAFs will have to do anyway, because liquidity will be limited and you might not be able to get out for up to 5 years or something like that. Anyway, lots been going on this year, as I've said. And I thought I'd take a quick look at some of the things that have been happening in this short podcast. So I'm going to start, I think, with the structural things that have been going on, by which I mean all this corporate action. Let's start with Saba Capital. We know they launched their first, if you like, mega campaign at the end of last year when they requisitioned meetings to try and use their significant shareholdings to force the boards to hand over the management of those trusts to Saba itself, in the process getting rid of all the directors themselves. Well, that, as you know, made a lot of headlines and produced a lot of flurry of activity by the boards of those trusts in question. The 7 that were the target of the initial Saba campaign, or initial Saba public campaign, they had been building up shareholdings in a number of trusts for a period of well over a year before that, steadily adding to their number of holdings. But anyway, that resulted in a fight back by the boards, who had tried to enlist the support of shareholders to see off what they regarded as opportunistic and unwelcome efforts by Saba to take over the running of the trusts. And in that, of course, they were successful. Saba gained barely any votes in the process and lost, if you like, that round of the battle. But battle it remains, because Saba has not gone away. It retains a significant shareholding in 3 of those 7. In 3 other cases, the trusts have effectively abandoned their investment trust status in one form or another, those being Keystone Positive Change, Henderson Opportunities, both of which offered investors a cash exit or a rollover into an open-ended fund equivalent, and CQS Natural Resources, which held a tender offer in which Saba took the opportunity to get rid of its stake. CQS Natural Resources still continues as an investment trust. It's a bit smaller than it was, but that's battling on. Middlefield Canadian Income is the other one, which has effectively ceased to be an investment trust. It's just announced that its plan to turn itself into an active ETF with a cash exit for shareholders has just been completed. So those 3, Middlefield Canadian Income, Keystone Positive Change, and Henderson Opportunities, have effectively done pretty much what Saba wanted in one form or another. Without handing over the management contract, they have allowed Saba to obtain their wish, which was to convert the investment trust into a different structure where the discount would not be a problem anymore. And 3 of them, that is Herald, Bailey Gifford US Growth, and Edinburgh Worldwide, another Bailey Gifford managed trust, they remain pretty much where they were. Saba still has a big shareholding, and the shares are trading at a discount, wider than they reached around the time of the vote. But there's still the game to be played out there. What will happen to Saba's shareholding? What will Saba try and extract from the boards by way of a concession that may allow them to get out and make a profit in some cases, not always, from their stakes? So those 3 stay there, while, as I mentioned, CQS Natural Resources has managed to get Saba off the register. So too has another trust, a couple of others actually, where either the board has been able to negotiate a standstill agreement with Saba, where they won't come after them again for the next couple of years or so, and another case where a board chose to buy back the stake. That's one of the Montanaro investment trusts. So Saba's shareholding there is smaller than it was at its peak last year. Now, that's not the end of the story either, because not only has Saba sold out of 1 or 2 of its positions, but it's also been building new positions or increasing its holdings in a number of other trusts. So in about 9 other trusts, it has a shareholding of at least 10%, some of which has been built up quite recently. Most notable names there would include Schroeder UK Midcap and Smithson, also BlackRock Throgmorton, one of the smaller company trusts, and also BlackRock Smaller Companies, where there's a 10% shareholding with Saba. So that is one of the cases where Saba remains on the register in size. And then there are a number of other smaller trusts, 1 or 2 of which are new holdings for Saba, including a small number in the alternatives sector. For the first time, they've been building up relatively small stakes at the moment in 2 or 3 alternative asset trusts. So this is a new stage for them. They include Life Science REIT, Syncona, and Molten Ventures, plus Gore Street Energy Storage. So exactly what Saba wants to do here, we don't know. 2 of those trusts actually are already in managed wind down. So this may just be a pure arbitrage play by Saba. Both Life Science REIT and Syncona proposed an orderly wind down realization earlier this year. And so you could argue that Saba's involvement may or may not have had a bearing on that. So Saba is still there. There have been reports that it's trying to raise more money, which, if it does do that, will build up its war chest, and it may be coming after more investment trusts if their discounts remain at wide levels. So Saba has had a huge impact on the sector, both on those individual trusts that have had to change course or reduce in size, or indirectly by sitting on the register and forcing boards to contemplate their future with such a potentially hostile or at least aggressive shareholder, one could say, on their register. Now, of course, there's been a huge topic of discussion all year about Saba's involvement in the investment trust sector and whether it's been a force for good or ill. Those boards that were caught up in the initial campaign, the first 7, they have complained a lot about the hassle, the cost, and so on of having to see off Saba and being critical of the fact that they have tried to use their significant shareholdings to force a result from a board that is not necessarily in the interest of all shareholders, only themselves. Well, there's truth to those criticisms, I think, but I think Saba would also point out that actually, overall, the impact of their involvement has been positive in the sense that it has forced boards, particularly those that have been perhaps a little slow to confront the issue, to start dealing with the discounts at which investment trusts have been trading for a long time now. And indeed, until last year, the discounts were even wider than they are today. As I said before, it has produced a very significant response from investment trust sector. To give you one example, nearly 100 trusts have bought back more than 10% of their shares over the last 2 years. I've included a table in the next edition of the handbook coming out in December that lists all the trusts which have launched the biggest share buyback programs, comparing that to the market capitalization they had when they started the process. And in some cases, that's been very successful in eliminating discounts. In others, discounts have remained very wide. And that in turn has prompted a great debate about whether or not share buybacks are an effective way of dealing with discounts. A number of board directors I've spoken to feel that they are not effective or have not been effective, or at least not been visibly effective, and that therefore maybe there are other ways that the board should be dealing with this issue. Obviously, there is an issue around potential conflict of interest between the managers of investment trusts and the boards, in the sense that management fees, if you buy back shares, in most cases will reduce for the managers. And so it's not been a surprise that in some cases managers have been resisting an increase in share buybacks. But as I said, overall, the sector has engaged the share buyback solution with huge and perhaps overdue vigour, welcome but overdue perhaps, and the number of buybacks has reached a record this year. And given that the IPO market has been effectively closed, we've only had one very small IPO of more than 30 million. That was Achilles earlier this year. Given that there have been effectively no significant IPOs for 4 years and only a limited amount of secondary issuance by existing investment trusts, that means that there have been overall a significant outflow of capital from the investment trust sector. It is shrinking, and that's because of all these measures that have been taken. And that has been a very notable trend, and that has, if anything, accelerated in the past year. We've seen a lot of mergers, we've seen a lot of M&A activity. The commercial property sector has been perhaps the worst affected by that, with many of the larger diversified commercial property trusts disappearing, either being taken over or merged with another vehicle. London Metric being one of those. That's a REIT listed on the main market. So it's still investable by shareholders, but it's not an investment trust anymore. And what we're waiting for, I think, is fair to say, we're waiting to see how the continued very wide discounts in the alternative asset sector are going to play out. We know that it's much harder for boards in the alternative asset sectors because the trusts are investing in are private assets on the whole. They are difficult to realize. You can't just click your fingers and get rid of them, as you can much more easily if they are quoted investments. So boards there, most of them have taken a lead. One of the first to do so was Pantheon International, the private equity trust, in setting out what we call capital allocation plan. So saying of all the cash that we bring in, how much are we going to dedicate to reinvesting in the assets we have? How much are we going to pay out as dividends? How much are we going to use to repay debt? And how much, if any, are we going to use to do share buybacks and try and tackle the discount? So a number of boards have come out with broad parameters, which they say are going to guide the way that they manage the trust from here on. And it's been different horses for courses in a way, different patterns of policy, depending on the kind of trust and who's managing it, who's on the board. So that is gradually beginning to have effect. But I think here is evidence that discounts have not come in, and they do remain very wide. And in certain cases, notably the renewable energy trusts, which have had another poor year, their discounts have actually widened on average. And we have yet to see much of the kind of consolidation M&A activity that we have seen in the commercial property sector. So, question there, is there something wrong with the renewable energy model? The market certainly seems to think so. The dividends that these renewables pay out in many cases are very handsome, 9-10%, well above the rate of inflation, so 6% real. And this year, at least, mostly covered by earnings. But because many of the renewables have long-term contracts which bring them subsidized income, one form or another, from the government in its renewable energy policy objectives, those periods of subsidy will be coming to an end, not in the next 2, 3, 4 years, but in the foreseeable future. And with power prices being lower than expected, the mark-to-model numbers, in other words, the net asset values which these trusts have continued to report, they have been declining this year, but maybe they are still too high. And that may be the explanation why we have not seen more activity you would have expected private equity or pension funds or other large institutions to come in and take out some of these investment trusts, given the wide discounts at which they're trading. Why have they not done so? That's a question I think we all have to think about. You are listening to our Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. So that's some of the things that have been going on this year. The good news is that if you look at the table of relative performance between investment companies and equivalent open-ended investment companies, i.e. OICs, in other words, comparing the closed-end structure of an investment trust with open-ended funds that can be directly compared, often run by the same manager. The good news is that this year, yet again, for the great majority of sectors in the equity portion of the investment trust world, the investment trust is outperforming again the open-ended equivalent, suggesting that the much vaunted long-term attractions of this structure are still, or perhaps I should say once again, beginning to work their magic. So investment trusts, the best ones that remain anyway, they are performing better than open-ended equivalents. And that is one of the pillars on which, if you are going to see this campaign to remake the case for investment trusts that I've been talking about, has to be part of that. Better performance and the other benefits that we have of freedom from investor flows, up to a point at least, the ability to gear and so on, and the ability to draw on reserves to continue paying out dividends from reserves, which otherwise might have to be cut. So the positives are still there in theory, but I think after 3 to 4 tough years, the investment trust sector has got to do a bit more to encourage more new investors to come in. Obviously, part of that solution may be an end to the cost disclosure issues that has been the subject of a lot of campaigning over the last 2-3 years. The government, through its digital task force, has promised to get the FCA to finalise its consultation about the new regulatory regime. And part of that should be to end some of the anomalous cost disclosure treatment that investment companies suffer from. Whether that will make a big difference, we don't know, but that certainly could be part of the general improvement and remarketing program that I've been talking about. Discount control policies will be obviously important. More of those around now, more continuation votes, more performance-related tenders coming more often than in the past. These are all measures that boards can take, as well as buybacks, in order to try and keep discounts under control. Because the fundamental problem is a mismatch between supply and demand, and there's only 2 ways to deal with that: either increase demand or reduce supply. We've seen some of the supply reduction measures, and we're beginning to see some of the demand encouragement measures as well. I mean, most boards of most investment trusts are now fully aware of the need to engage more with private investors. They've noticed the consolidation of the wealth management industry, which means that they are going to be not as significant buyers of investment trusts in future. And they are therefore putting their effort behind trying to recruit more private investors to the cause. And to do that, they've been adopting a whole range of measures, including better communication, more information disclosure, tarted up websites, more seminars, webinars, and so on, and sponsoring a lot more research. Though a lot of sponsored research is, of course, just that, and needs to be treated with that caveat in mind that the research is being paid for effectively by the trusts themselves. Moneymakers, of course, is an exception to that. Our in-depth profiles of investment trusts are entirely independent. Nobody pays us to produce them, and we say what we think. So I hope that will always remain a key part of the research process that you do when you're looking to invest in an investment trust, either for the first time or as a returning investor, looking at the discounts today and trying to work out whether they are an attractive option or not. So, as I say, a lot of change this year. Decent performance. The performance of the average investment trust has been pretty much in line with the indices, FTSE All-Share and the World Index. In fact, both of those performed relatively similarly. And, double-digit returns, if you're lucky enough to hold the ones that have benefited from those market gains. And even better, if you've benefited from the ones which have delivered over and above that, then it's not been a bad year so far. We don't know, of course, how the great dramas that are going on in the wider world will play out. How the war in Ukraine and in Gaza, will they actually be ended? We've yet to see confirmation in either case. The impact of President Trump's tariff wars, that has introduced a lot of volatility and uncertainty into global markets. Interest rates, where they're going, that uncertainty remains. Seem to be coming down in some countries at the short end of the curve at least, but been rising at the longer end, as bond markets focus on the fiscal sustainability of governments. And valuations, obviously, as we know, remain very high in some markets, US in particular, at least in the case of the big tech companies that have been dominating market performance for most of the last few years, though not quite as much this year, has to be said. And the risk of either recession or inflationary surge, those risks have not been eliminated by any means. So very uncertain global picture. That will have an impact on the way that financial markets behave, and investment trusts cannot be immune from those impacts. And closer to home, we have the budget coming up, and we'll hope that the measures introduced by the Chancellor, Rachel Reeves, will first of all calm the anxiety of the bond market and bring down longer-term borrowing costs. No certainty that she'll be able to do that, of course, given the amount of borrowing she's having to do already. And then whether or not the tax measures that she introduces in the budget, we know they're coming. We don't quite know which ones yet will be on her agenda, how quickly they'll be introduced, and indeed what the impact of those will be. Last year's measures putting higher national insurance contributions on employers has not been a helpful precedent. So a lot of uncertainty out there, which will impact on the absolute level of performance from the investment trust sector. But in a more parochial way, the measures that most trusts are now taking, they are trying to demonstrate that their interests are aligned with shareholders. And in the ways that I've described, they are beginning or hoping to see the revival of demand. And it may not take a lot for us to be back into a world where we see the happy combination of decent performance and narrowing discounts combining to produce above average returns from the investment trust sector. Will it happen? Well, we'll have to wait and see. One has to be realistic about these things. But I think the verdict on the first 9 months of this year is that things are getting better. So that's it for this podcast. I'm sorry you've had to listen to me banging on for so long, but next week we're back to normal and we will be taking a look, among others, at the biotech sector, which has been on a strong run. One of those cases where the trusts in that sector have been performing very well over the last 2 or 3 months. So more on that next week.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.